Fiscal Policy and the Job Guarantee by William Mitchell and Warren Mosler. Reserve Accounting: Why Debt Monetization Does Not Apply. Deficits, surpluses between the public sector and the private sector, more, less government outflows than inflows, have major implications for what is termed system-wide liquidity and promote changes in the reserves in the financial system. See RBA 1996 for a review, the operations of the payments and settlement process. To fully understand the financial analysis that underpins the job guarantee, we need to consider the portfolio adjustments that accompany the increase in outside money, deficit increase. The likely transmission mechanisms are as follows. A. The job guarantee worker receives the difference between the unemployment support and the job guarantee wage, and will probably increase his/her consumption commensurately. B. Some agent along the resulting expenditure trail may desire to increase their holdings of cash. C. If the increased demand for cash is less than the injection, then eventually there will be an excess cash supply manifested as excess reserves in the exchange settlement (ES) accounts of the commercial banks at the central bank. Exchanges between ES accounts in settlement sum to zero in terms of the system-wide balance, and so in net terms, the money market cash position is unchanged. In Australia, only transactions between the Commonwealth government and the private sector change the system balance. Government spending and purchases of Commonwealth government securities, CGS, by the Reserve Bank of Australia, RBA, add liquidity, and taxation and sales of CGS drain liquidity. These transactions influence the cash position of the system on a daily basis, and on any one day they can result in a system surplus deficit due to the outflow of funds from the official sector being below the funds inflow to the official sector. The system cash position has crucial implications for RBA monetary policy, which targets the level of short-term interest rates. The system balance is an important determinant of the use of OMO by the RBA. On any day, the transactions between the Commonwealth government and the private sector will not usually net to zero. The RBA pays a default return equal to 25 basis points less than the overnight cash rate on surplus ES accounts. Assume that the government runs a fiscal deficit. This results in a system-wide surplus after the spending and portfolio adjustment has occurred. The commercial banks will be faced with earning and lower default return on the surplus ES funds. This will put downward pressure on the cash rate. If the RBA desires to maintain the current cash rate, then it must drain this surplus liquidity by selling government debt. Therefore, the role of government debt is not to finance spending, but rather to maintain reserves such that a particular cash rate can be defended by the central bank. What would happen if the government sold no securities? The penalty for the government would be a Japan-like zero interest rate, rather than the positive cash rate target. Importantly, any economic ramifications, like inflation or currency depreciation, would be due to lower interest rate rather than the government deficit. Accordingly, the concept of debt monetization is a non sequitur. Once the cash rate target is set, the RBA should only trade CGS if the liquidity changes are required to support this target. Given the RBA cannot really control the reserves, then debt monetization is strictly impossible. Imagine that the RBA traded CGS with the Treasury, which then increased government spending. The excess reserves would force the RBA to sell the same amount of CGS to the private market, or allow the cash rate to fall to the support level. This is not monetization, but rather the logic of an interest rate setting monetary policy. Aspromorgus, 2000, disputes this analysis and concludes that deficit spending must be financed by the issuing of securities. He constructs his case in terms of the following derived version of the government budget constraint. G plus IB equals change in delta M super D plus T plus delta B, or G minus T plus IB minus delta M super T plus change of B. He then chooses to see the issue in terms of whether the government is respecting of private sector preferences for money versus securities. Emphasis in original. Aspromorgus, 2000. However, once we cast the argument in terms of the possible outcomes of adjustments by those not content with their portfolio compositions, we have moved beyond the more simplistic argument about financial constraints on net government spending. Footnote 13. It is clear that only in extraordinary circumstances would the central bank dishonor a government check. In that sense, there are no financial constraints on government spending. Accordingly, the debate has to shift to analyzing the implications of that spending for the real sector and the portfolio preferences of the private sector. David Gruen from the RBA conceded this point during the Creating Jobs, the Role of Government conference at the Australian National University. End footnote. Of course, the following equation is equally true in an accounting sense. G minus T plus IB minus delta M super D equals delta B plus delta M super U, where delta M super U represents the unwanted cash balances and manifest as excess reserves in the banking system, earning some support rate from the central bank, which could be 0. Delta M super D will most likely be positive if only because the expansion will increase the transaction's demand for cash. The issue then is, what are the implications of delta M super U not equal to 0? Aspromorgus, 2000, tries to reduce this to an issue of semantics. Quote, this indicates that to sustain G in the sense of ensuring its consistency with private sector portfolio preferences in a market economy, government, or its agent, the central bank, must issue interest-bearing securities of some kind to enable the private sector to release itself from an undesired holdings of outside money. In this sense, the increase in government securities held by the private sector is an essential part of the process of sustaining G. It matters little whether one calls this a case of securities, financing G, although this is surely reasonable language for describing that process. It is the substance that matters. The increase in the private sector's holdings of government securities is an essential part of the process of successfully affecting the government expenditure. End quote. But this is equivalent to asking, what if there are no bond issues? We have already analyzed that case. Aspromorgus is suggesting that the private sector ultimately imposes the limit on deficit expansion via its reaction to the portfolio disturbance. The bond issues keep testing the willingness of the private sector to hold government paper after adjusting their cash holdings, and hence the extent of spending. Ultimately, private agents refuse to hold any more cash or bonds. Then Aspromorgus 2000 says, quote, the unsustainability of the policy would be manifest in an incapacity to keep official interest rates down at desired levels, and probably inflationary pressures, as agents sought simultaneously to move out of money and government securities. End quote. With no debt issues, the interest rates will fall to the RBA support limit. It is then also clear that the private sector can only dispense with unwanted cash balances in the absence of government paper by increasing their consumption levels. This reduced desire to net save would generate a private expansion and reduce the deficit, restoring the portfolio balance at higher private employment levels and a lower job guarantee pool. Whether this generates inflation depends on the ability of the economy to expand real output to meet the rising nominal demand. That is not compromised by the size of the budget deficit. The job guarantee policy does not require the government to push net government spending beyond the capacity of the real economy. More far-fetched would be the situation where the private sector refused to sell goods and services to the government in return for government money. Then limits on government spending would occur, but it is difficult to see a profit-seeking firm turning down sales just because the source of spending was a government check. To repeat, there would be no desire for government to expand the economy beyond its real limit. A final related myth concerns the notion that budget surpluses create a cachet of money that can be spent later. Government spends by crediting a reserve account. That balance doesn't come from anywhere, as, for example, gold coins would have to come from somewhere. It is accounted for, but that is a different issue. Likewise, payments to government reduce reserve balances. Those payments do not go anywhere, but are merely accounted for. In the USA situation, we find that when tax payments are made to the government in actual cash, the Federal Reserve generally burns the money. If it really needed the money per se, surely it would not destroy it. A budget surplus exists only because private income or wealth is reduced.